Hello, good evening. We are live tonight and we are talking about Capital One purchasing Discover. We're talking about SBA and all of the EIDL defaults and charge offs, what's going on with that. We're also going to discuss the mortgage rates, all right, and how mortgage demand has absolutely declined over the last few weeks because mortgage interest rates are at 7%. So let's get right into it. Of course, thank you for joining. Please, if you want to chime in, definitely leave a comment in the chat or leave a comment later when you watch this later. So let's talk about Capital One. And I have my notes right over here. So you're going to see me glance to my right. So Capital One, $35.3 billion. They're proposing this merger with Discover, which poses not necessarily issues, but here's why they may want to do this. So one is cutting out the middleman. All right. So Capital One, if they purchase Discover for the $35.3 billion, and this has to be approved. This is not 100% happened yet. It has to have approval. But if they do that, they're going to be cutting out the middleman. And what do I mean by that? So right now, there are four major credit card networks, and those networks are Visa, MasterCard, American Express, and Discover. So if Capital One buys Discover, they now are a credit card network. So I even had to look this up. What is a credit card network? So a credit card network, if you have a credit card, I'm sure you do. On your credit card, you're going to see your bank, but you're also going to see Visa or MasterCard or American Express at the bottom. And that's the indication of what network that your credit card is through. Okay, so what role does the network play? The network actually has the infrastructure to make sure that money gets from you, the customer, to the merchant, or from your customers to you as a business owner. So that they have that infrastructure, and that's where processing fees come in. So these four major networks, Visa, MasterCard, American Express, and Discover, they make money through processing fees. So if Capital One merges with Discover, they're going to now be a credit card network as well. And it's just going to give them a whole lot more leverage. Now, they want this thing to pass. They want this thing to be voted in, or they want a favorable vote and approval as it pertains to this merger. So they're really pushing this aspect of, oh, if we are now a network by acquiring Discover, we can be more competitive as far as credit card processing fees, and we can offer more features to the merchants and the consumer. Now we will see. This is big business, so there is an agenda, but we'll see. Now there are some Democrats who are concerned about this merger because if Capital One merges with Discover, they're going to be the largest credit card company, even surpassing JP Morgan Chase. So some feel that that can be problematic because they're going to have a big corner of the market share. They're going to be the largest credit card company, and that may be problematic to consumers and small business owners. But I definitely want you to chime in. Do you know anything about this merger? What's your perspective? Do you think it's a good idea? Do you think it's a bad idea? And then what type of impact do you think it's going to have economically and in just the credit card space? I want to know your opinion. I want to know what you think, how you feel about it. Do you have an opinion at all? So $35.3 billion. But again, this must be approved by regulators. They're hoping to get this approved by the end of the year, ideally by the beginning of next year, but we will see. Okay. Next thing we're going to discuss tonight is SBA EIDL charge offs, which are crazy. So during 2020, I don't want my video to get flagged. Everybody knows what happened during 2020. So during 2020, SBA made loans available for small business owners. One of the loans was PPP, but that was like a temporary loan because you could get that forgiven. And then the loan that was not forgiven was the EIDL loan, Economic Injury Disaster Loan. Well, in 2023, SBA charged off $52 billion in principal EIDL balances, which equated to about 17%. And that's an issue because most payments were not due for at least 30 months, and then there was an extension for 36 months. So the indicator here is that people got the loans in crisis, and some feel that, hey, these should have been forgiven just like PPP. I definitely want to know your opinion. So, leave a respectful comment because I do want to hear from you. Like, do you feel that EIDL should have been forgiven just like PPP? Do you feel as though it should not have been forgiven, and then why? So this is a clear indication that time payments came due. Either businesses had closed or there were some business owners who never had any intentions on paying the loan back. Either way, and there was a lot of fraud. I mean, these programs were fraud plagued because they were so easy to get. I heard about it, but I don't have an opinion. One thing I know, Capital One is not a bad company. I have 3 of their credit. Capital One is not a bad company. Okay. I personally have Capital One credit cards. And I have Capital One personal and business. Capital One has been great to me. I don't have anything negative to say either, but I just want to know you guys' opinion because I'm just presenting the information. These are, I guess, important things that are taking place in the finance world, in the business world, in the money space. It's a lot going on with the economy right now. So I definitely want to hear your opinions and your dialogue. So back to SBA EIDL. 17%. So 17% is $302 billion. Well, it's not $302 billion, but the principal balance of all EIDL loans, the amount that was lended was 302 billion. 52 billion has already been charged off. So let's get into what does it mean for it to be charged off? Because some people are thinking, okay, if it's charged off, does that mean it's forgiven? Like, what's going to happen now? So per SBA, loans are charged off if SBA determines no additional principal and interest from the borrower will be recovered via the agency. Now, it's really important, that phrase, via the agency, because what's happening is, I'm going to get into that in a second, but in September of 2023, SBA said, hey, we are not doing collections of any borrower who borrowed $100,000 or less. They got a lot of political backlash because of what precedent that would have set. So they had to recant that back in December and say, and the reason they did this is because pretty much SBA did not have the capacity to fulfill collections against all those borrowers who had loans under $100,000. So once all this backlash happened, this political backlash, they then had to recant that decision and say, okay, we will be pursuing collections, but we're not going to do it because we don't have the capacity to do it. I think sometimes we have a lot of faith in our government departments and entities, but the reality is everybody is faced with with everybody is faced with challenges, and as it pertains to the supply of workforce. So workforce challenges. So these programs had never lent on the scale they had to lend in 2020 and 2021. So they had to hire a lot of different contractors. So imagine now, in addition to handling all of the processing that comes with EIDL, the payments and things of that nature, now you're saying, okay, there is a huge portion of people who will not be paying it back. I don't think they have the capacity to handle all of the collections, all of the different processes, reporting to all of the credit bureaus. It's too much for them to handle. So what they have done is they are deferring defaulted loans. They are deferring charge-offs to the Treasury Department because the Treasury Department has the capacity to do what's called aggressive collection actions. Right now, we're just seeing that aggressive collection actions are going to look like you're not going to get a tax refund. You're not going to be able to get loans, SBA loans in the future. We have not yet seen on a large scale. Now, if you're seeing something different, correct me if I'm wrong, but based on the research that I've been doing, the Treasury Department is not going after borrowers from a personal property perspective, going after bank accounts, suing borrowers. So, that's what's taking place right now. But we will see. It's that the fiscal year for EIDL, I'm sorry, the fiscal year for SBA ended in September 2023. So October, November, and December, we don't know how many more charge-offs took place. So I'm very interested to see 17% already being charged off in just a few months after payments began being due. I am interested to see what happens, and I want to know what you think. Like, do you think how much more do you think EIDL charge-offs are going to increase, and what kind of action do you think is going to have to take place? Because the Treasury Department, yes, they do have the capacity to garnish wages and do aggressive collection action, but just based on the sheer volume, are they? And I guess we'll just have to see how that plays out. So next, and not final, but the next topic I want to go over tonight is mortgage rates. Mortgage rates are back at 7%, unfortunately. Now, I do invest in real estate actively. I've actively invested in real estate for many years, and I was born in the 80s, but I network with a lot of older real estate investors. And yes, interest rates are high, but interest rates were even higher in the 80s. Okay. So I'm just put that out there. Okay. Don't harm the messenger. I'm just putting it out there that 7% is not the highest that interest rates have been. And if you bought houses, because a lot of my audience, you guys are in your 50s and 60s, and even some of my audience, you're in your 70s. I want to hear your perspective on real estate, the mortgage interest rates, especially during the 80s. Like whether you were a real estate investor or whether you bought your first home in the 80s, what were your interest rates like? And then what did you have to, of course, I'm going to throw this out there. Houses were not as expensive. Inflation was not as high in the 80s. We know this. We know you could have bought a beautiful $40,000 house in the 80s, and now at least where I live, to even get a starter home, it's about $350,000. Like to get a starter home that you don't have to go in and and renovate or update, that you could just walk in and live in with your family. A starter home is about $350,000. So I get that part, but I do want for my older audience members who have seen high interest rates, what is your perspective? What was that like? Now let's roll back into. I love talking about real estate. I don't talk about it as much here on the channel, but since we're on live, I'm gonna talk about it. Okay. So interest rates are at 7%. That affects people's buying power. That affects you, that affects me, that affects our buying power. So, of course, demand for mortgages has decreased. Demand for refinances has decreased because it's like, what's the point in refinancing if we're back at 7%? If we were at 6% or 5%, and I'm going to show you guys an illustration. Well, not show you, but on my iPad, I'm going to do some numbers to show you what does affordability look like at 7%? What does affordability look like at a 5% interest rate when we're talking about buying real estate? So the purchase index fell by 10.1% from a week ago. And that measures the mortgage applications to purchase new homes. It fell 10%. All right. And we all know why. So what I want to do here is I want to look at how is affordability really affected? Okay. So if you were to buy a $400,000 home, now I'm using a mortgage calculator, and this is saying 80% down. If you're doing FHA, you're not paying, I'm sorry, 20% down. If you're doing FHA, you're typically not doing, you're doing 3.5% plus closing costs. So you're not doing 20%. But for illustration purposes only, $80,000 down is 20%, 30-year term at a 5% interest rate. And they're low on property taxes and home insurance, but we're just gonna, principal and interest would be $1,700 based on this estimation. The mortgage payment, including property taxes and homeowners insurance, would be $2,093 a month at 5% interest rate. And I just want to show you guys, this is why people are being impacted. This is why demand has decreased for mortgages. Let's look at 7%. Okay, if we increase it to 7%, So remember, $2,093 roundabout, that's the mortgage payment, including property taxes and home insurance. If we go to 7%, $2,500, and that in many households is a make or break. Like $500 increase, or it's really about $400 increase, but a $400 increase, that $400 can go towards gas and transportation. It can't go towards a car note because car notes are sky high. I mean, car notes, I've heard $1,100, $800, $1,000 for car notes. So we can't say that $400 would cover a car note, but that $400 may be covering groceries. That may be the difference between being approved and not approved based on the debt to income ratio of a borrower. So I just wanted to show you guys like a real life example when I'm going over these topics that can go over many of our heads because we don't necessarily talk about them on a regular basis. I always like to give you a real life perspective of what that looks like. So there you have it. The mortgage rates. We thought that the Federal Reserve was going to do a rate cut. They did not. They decided to keep things where they are for whatever reason. Probably because of inflation. And because of that, mortgage rates have also increased because the Federal Reserve, they set the precedent as it pertains to how much money is going to cost. And every other, it just trickles down and affects the consumer. So that's what we're seeing. I want to know, are you guys in the home buying process? Do you know somebody who's in the home buying process? I know many people are sitting on their properties right now. I'm sitting on my property, but I had no plans on selling my primary home. My interest rate is great, right? You have 2% interest rates, you have 3% interest rates. I'm not looking to pivot to a 7% interest rate, me personally. I don't know about you, but I'm content in my home and I'm not looking for a 7% interest rate. And the prices are inflated right now, in my opinion. Now, I am not going to speculate and say, oh, there's going to be a real estate crisis. I've actually been in real estate long enough to know demand is still low. Demand is still low. And builders like D.R. Horton, D.R. Horton is a huge builder around the United States of America. They are still building and selling homes because they own a mortgage company and they're able to buy down the rates. So you can buy down your rate. I know that we were considering refinancing our home and we had an option to buy down our rate. But when I did the calculation over 30 years, it did not make sense. I think we were paying $100,000 over the course of 30 years. So that didn't make sense for me. But if you are looking for a home right now and you want to, I personally don't like the quality of new construction right now at all. But if you have no other choice, you need to get in a home and you're going after a new construction and it's not a custom build, it's a builder that's building your home, then there is an incentive to be able to go in and they say, hey, we're going to buy down your rate to 5%. When the national average is 7, which is why you will continue to see big builders like D.R. Horton continue to buy up land and develop that land and build houses. And while we are seeing resales just sit on the market because the average homeowner does not consider, and the average realtor is not saying, hey, homeowner, you can contribute more closing costs so that they can buy down their rate so that you can get your property sold. And also in combination with that, a lot of the resales are dated. They were built in the 80s, well, 60s, 70s, 80s, early 90s, and the interior is dated. So for the novice home buyer, when they go into a new construction home and everything looks shiny, even though the quality is poor, everything is new, everything is shiny, and they get a 5% interest rate. That's why we're going to continue to see these developers and these builders continue to build in high volume. So I hope that information was helpful to you, whether you watch this now or later. I appreciate you watching. Definitely leave a comment. I want to hear from you. what do you think about all this? What do you think about the economy? How is it impacting you? How is it affecting you? But definitely, how do you feel about Capital One and Discover and that merger, and how do you feel that it will impact you and others? All right, until next time, you guys have a great one.